All right, once again, good evening. Good evening and welcome to tonight's meeting. This is the third day of the 2 weeks Forex basic course. And tonight, previously we've looked at other topics. Tonight we'll be looking at support and resistance. Okay? Be looking at pullbacks, we're looking at trends. I will also be looking at lots and pips calculation. So we'll be running this for 1 hour, then 30 minutes will be for questions and answer as usual. So please pay rapt attention as I run you through this presentation. Good evening. All right, my name is Rekel Banobo. Should I didn't tell you my name and you didn't know my name before now, I'm the administrator of Jfbc Academy. All right, so this is where we begin tonight. Support and resistance. Now, in the Forex chart, there's what we call support, there's what we call resistance. Let's take a story building, for instance. You are in the first floor of a story building. The floor you are standing on the first floor, is supporting you. While if you look up, maybe if it's a 2-3 story building, if you look up, you will also be seeing a decking, a ceiling. What that ceiling means, what that ceiling is a resistance. So the floor is supporting you, okay, so that you won't fall or you won't go down suddenly. While if you jump to cross the ceiling, then you get yourself hurt by hitting your head on the ceiling, and the ceiling will bring you back down. Okay, so that's more like, a first example of support and resistance. Now, small definition here said this support is like the floor where price hold. A floor where price hold. Where price turns around and go up. Price respect this region so much. We can authoritatively say at this region, there are so many buyers. That is high demand. We can also say support is where the law of demand is effective. Now, in buying and selling, you've done economics, and in buying and selling, when there is so much demand, what happens? The price goes up, right? Is it not so? When there's so much demand of a particular product, the price goes up. Okay, so support, what this explanation is say we can say support is where the law of demand is effective. Hence, the conclusion that we buy at support. Because we want to buy at the lowest price, anticipating a rise so that we can sell at a very high price and make profit. You want to make profits when you buy goods, when you buy commodity, anything you're doing buying and selling. You want to buy cheap, buy low, and sell high. That is how it is in this global financial market. So the chart is what you use in checking the price, what you use in having, that's where the data of the price movement stays. That's the chart. The data of the price movement, that is where it stays. Everything you need to know history, okay, because the chart is actually, it's a history. It tells you what has happened in the past. Probably using the scenario of what has happened in the past, you can also probably forecast or say you predict what you believe will happen next, because the market is a cycle. Okay, the market is a cycle. It rotates, it turns around over a period of time. So what has happened before will eventually happen again. It's a cycle. So now let's look at resistance. Say this is like a ceiling where price struggles to break through or go above, but couldn't. It is that region where price is always rejected or push back downward. Hence, it is needed to draw the resistance line to serve as a guide. We sell at resistance because our understanding of what price does at that region. At resistance, there are so many sellers at that region, so price falls. Now, you have bought your goods at a low price, okay? You bought when the price was low. But over a period of time, the price has appreciated so much and you want to sell. So the same time you want to sell, plenty other people too wants to sell. So you can see that a lot of people are at that region, okay? So in this case now, the supply is high. When the supply is high, what happens? The price drops. So at resistance, there are so many sellers at that region. So price falls, respecting the law of supply. Okay, so note, support can become resistance and vice versa, depending on where price is coming from. It is also noteworthy, as much as price touches the zone, the weaker it becomes, until a full force breaks through it, after which it becomes support or resistance, as the case may be. Now, I gave analogy of a ceiling and a decking first floor initially. So when price begin to touch a particular resistance, pushing it for so long, after a while, that resistance becomes weak. What happened? Price breaks through it and pass through that level. That level now automatically becomes support. Okay? Now, take for instance, if you have a sledgehammer, you are standing on a decking, all right? You're on the first floor, and you have a sledgehammer. You started hammering that place. Maybe you started hammering it first day of the month. You keep hammering it every day. You are hitting it. You are hitting it. Over time, what will happen? That place will become weak, no matter how strong it tends to be. It may only take time, but after a while, when it becomes too weak, what will happen? It will break and open, and you can go to the floor. So that support before now is now resistance because price has fallen below that level. Okay, I will show you this in uh, in a chart, but before then, let's look at what pullback and trend is. So when I go to the chart, I will show you what support, resistance, pullback, and trend, okay, is. So what are pullbacks? What are pullbacks? How do you use pullback to enter the market? Pullback is a market situation where price tries to move in an opposite direction for a short while before continuing in its original direction. It can also be called a retracement, a point where price pause before going to the main direction. A pullback will always occur after 2 to 4 candle is formed to make a correction. If you don't see it in the third candle, expect it in the fourth candle. If it doesn't, expect it in the fifth, as a huge move is taking that long, because in the forex market, there will always be the presence of both buyers and sellers. So the market is holding both buyers and sellers. So no matter the ultimate direction of the market, at some point there will be pause, all right? You know, a pullback. The market will push back a bit before it will continue in the original direction. Now, if you have been in my class before, this is what I always use. I'm in Port Harcourt, so we're in Port Harcourt here now, and you are traveling to Warri Delta State. Now, ordinarily, when you are traveling to Warri Delta State, as you enter your car, you are driving straight from Rumokoro to Choba, Choba to Elele, going to Ahoda, and so on, Bayelsa, before you find yourself in Warri. But in the case of this market, the market knows very well that it's going to Warri. Yes. But the market will not just begin to drive straight to Warri. The market will leave Rumokoro, get to Choba, it will return to Rumosi, and probably may even decide to sit in Rumosi and take a bottle of wine and enter the car again and start driving. Maybe this time it will drive past Choba and get to Elele. After getting to Elele, it will come back to Choba again, you know. Then the next, maybe the next move is going to move. It will now cross Ahoda, get to Bayelsa. And after a while, he said, no, let me go and eat lunch in Ahoda. He will leave Bayelsa again and come to Ahoda. So, but at the end of the day, after all of this move, the ultimate destination is Warri. The guy will still get to Warri, but yet he has played back and forth on. So that is what is called pullback. That is what is called pullback. It can also be termed retracement. Okay? So pullbacks form what we call correction of the market because for every move, it is called displacement. So for there to be a correction, there has to be a pullback. Okay? So note, one group, which is the buyers, can only be more than the others, which is the sellers, or vice versa, or a ranging market where you have equal buyers and sellers. Okay, so in the market, when we begin to talk about trend, we have an uptrend, we have downtrend, and we also have what we call range. Okay, range is when the market tends to remain in a particular area for a very long time. All right, creating equal highs and equal lows for a very long period of time. All right, so in that case, there is a level playing ground for both buyers and seller. So the buyers may not have been able to overshadow sellers, and sellers have not been able to overshadow buyers until one side build more momentum to push across. All right. So that's pullback. Please jot down your questions, anything you need to ask questions on. Don't fail to put it down because if you did not do that, you may forget when it's time to ask such questions since you don't have room to interrupt me for your questions right now. So please always jot down your questions so that when it's time, you can easily refer to what you have put down. So now let's look at trend. Let's look at trend, okay? Now, trend is the overall movement of the market. So if the market is buying, all right, for a particular period of time, it may be long, it may be very long, it may not be too long, all right, the market is going in that direction. So the price is going up, all right. In that case, it is an uptrend. Then when the price is going down, it is a downtrend, okay. So the buyers are more in the case of uptrend, while the sellers are more in the case of the downtrend. All right. Then the ranging market, which is also called consolidation, just like I explained earlier, is where we have equal players on both sides. So let's look at this short definition. Say a trend shows the overall movement of the market, having in mind that there are movements in same, opposite, and indecisive direction. Okay? Adeze Duncan was my teacher. She will always tell you that the trend is your friend. Because you don't want to go against the overall direction of the market, always go with the trend. Okay? I still have some videos of Adeze Duncan. I will drop that of trend. I'll drop trend, support and resistance, and probably lot size and pips. I'll drop those videos in the two groups so that you can have access to them. And you can also search Adeze Duncan on YouTube and probably search Forex 101. Okay, search Forex 101. Adeze Duncan is a born US, is a US citizen. Okay, she's Adeze, but she's not been to Africa before. All right, so buy. This is when the price rises. You want to buy at the lowest price so you can make some cool profits as the price rises. So sell. This is when price value prepares to fall. You sell it at a high, at the highest price so you can make profit when it goes down. Uptrend. Uptrend, say it has the higher highs and higher lows in the overall direction. There is a long buy and a short sell. You want to be in for a longer term buy in this kind of market. So you'll be coming across the higher highs and higher lows. We'll demonstrate them so that you understand what they mean in an uptrend. Okay. So you also see the higher lows and lower lows in the downtrend. We'll demonstrate all of it. All right, so downtrend. So this the market records higher lows and lower lows, i.e., the sells are longer than the buys, are longer and the buys are shorter. So we expect that irrespective of the kind of trader one is, you want to be on the side of the majority, okay? So you want to be with the majority. So that's what trend is. Trend is actually the best way for you to be a profitable trader. You want to check for the overall trend of the market and want to always go in that direction. We have people who do not trade pullback, they don't trade retracement. All right. Instead, they will wait for the retracement, the pullback to finish, then they enter from bottom instead of probably following it down or up. And at the end of the day, you are caught in the web. There are people like that. But someone like me, I trade all of them up and down, both pullback and the trend direction. All right, ranging. I have explained everything that is here. I've explained them earlier. So this kind of market is also called consolidation. The both economy is balanced. Equal numbers of buyers and sellers. No one is higher than the other. Remember, we traders are taking advantage of a weak economy, a balanced economy. So here in this market, we need to stay clear of this kind of market. Now, yes, we need to stay clear, especially when you are a newbie and you see a market ranging. You don't want to trade in that range. But do you know that there are some people, what they trade alone is the ranging market? So they wait for the market to come to the bottom of the range and they take a buy, escort it to the high of the range. They wait for the market to settle at the top and give a clear signal that is dropping again. They join, take it down. So if the market swing up and down for 10 times, they can be in for like 3 or 4 times to take out something. That's just some people's trading pattern. Okay, so we have looked at the trends, we have looked at pullback, we have looked at support and resistance. All right, theoretically. But now, let's now go to the chart and get some understanding of what we have just talked about. So let me uh, let me minimize this and go to my chart. Wow, so this guy dropped later. Hmm. Okay, the FMOC. Okay, FMOC. So it has finally come to close this gap. Okay, it has finally come to close this gap. All right, so there's a reason why we came here. So now we're talking about trend. First of all, we want to look at support and resistance. After support and resistance, we'll now look at trend. Okay, maybe I should go to daily. Okay. So this is gold. This chart represent gold. This gold chart. Now, please don't let the chart scare you. Because I remember myself when I was before I started trading. Each time I see people looking at this thing, I look at it as something very too difficult to do. I didn't believe one day that I'll be able to do it. Okay, so. Don't let it scare you. One thing you should tell yourself is that if Mr. A is doing it, then you can do it because he or she does not have two heads. Okay. But then there was nobody to talk to where you just see that things happen like this. So, all right. So this is actually the chart. So first of all, we want to look at support and resistance. So what is support? What is resistance? So first, I want to mark this place as resistance. Now, you also remember that resistance can also what? Become support. Now, support and resistance is determined by the current market price, okay? It's determined by the current market price, where price is as at the time, all right, of concern, where time is, where price is rather, okay? So right now, look at this level. This is a resistance. When price was still here, is called resistance, okay? Now this place is a resistance. So you can see what happened. The price came, touched it the first time, it rejected, it came down again. Came the second time, rejected, it came down again. Came the third time, rejected, it came down again. Came the fourth time, rejected, it came down. So by the fifth time, what happened? The price broke through it. So this resistance now have automatically become support. It was support, it was resistance when price was still below it. But as soon as price breaks through it, it becomes resistance, it becomes support. Okay? All right. As soon as price breakthrough, it becomes support. Now, if you look at this region as well, if you look at the bottom, okay, so maybe I should take this guy a bit up. So you can call this place a support. Now, before this market came into this place, it was actually a resistance. Okay, so it broke through, all right. It came to the first level, it didn't break, it came again. So this one break out. So sometimes we can call this one, all right, fake out. All right, the market is not ready to move yet, but it was able to push out and it came back in. So this became the second time, third time, fourth time, all right, before the market finally went up. So this is support. So when we talk about support, support is a level where price holds each time price come to that place. Now you can see how many times price actually hit this level before it broke through. So that's the same explanation I was trying to give, that you bring a sledgehammer and start hammering a decking for a period of time. No matter how strong the decking is, it will weaken and gradually it will burst open and you see yourself in the next floor below. Okay, so this is a very unique support and resistance, because this one happened at a consolidation. But support and resistance does not just end in a place where you see it very unique like this. Now, let me now fish out another support and resistance for you that you can see. So, You see this point? This is support, is resistance. So you can see what happened. The market touched here, it was resisting it. It kissed here again. After a while, it broke through, came down like this. So the market came down to touch it again. This is support. All right. If it broke through, it could not sustain, it weak out again and came back up. Finally, this guy too came, he weak out, and finally it broke through. So after breaking it, it came to retest, and what we are seeing at this point now is called see, this is a break, and this was a retest, and this is the continuation because the market is actually coming from the upside. Now, this is where the market is coming from, like this. Okay? So it's a downtrend. But the downtrend, like you see it now, did the market just begin to go like, no, it came like this, like this, like this, went up, did like this again, like this, stayed here for a while before it pressed. But the market is going down. Do look at the trend, downtrend. Okay, so first, we've been able to establish support and resistance on the chart. Okay, now support can become a resistance. Resistance can become support. Okay, so that's number one. Then number two, now let's now look at pullback. What are pullbacks? Okay, so now you can see that this market is going up, right? So this is an uptrend. This is an uptrend. The market is buying. The market is buying. They did not just buy straight like that. It did this and it pulled back here. So this was a pullback. This two candle is a pullback. All right. This small candle. So let me take it to like 4 hours so that you appreciate the pullback. At that particular level. I want to use it from that consolidation. Okay. So you can see that the market is coming from down. The overall movement is up. They did this. Okay, so this is an impulse move. This is a pullback. Okay, so this short movement now is a pullback. Now we got another impulse, and this was a pullback. This was another impulse, and this is a pullback. So we got this impulse. This is a pullback. This was an impulse. This is a pullback. So this is how the market moves. It does not just move straight like that. Now, when I use this part to mark it, it looks straight, right? But the candles are not straight. You just do jag, jag, zigzag like that. But over time, when you begin to work with the chart, irrespective of whether they are looking more like they are scattered, you should be able to pinpoint the high and the low. So in the market, when we say uh, higher highs, higher lows, that's when the market is going up. So now this is a low. Okay. So the low is labeled as L now in this case. So let me make it big. Okay, so this is a low. All right. And this is a high. Okay. Okay, so this is a low, this is a high. So this one becomes higher. This one become higher low. Okay, why? Because it's higher than this one, but is a low. This is a high. Okay, so now this one will now be higher high. Okay, higher high. So this one is higher high. Is a high, but it's higher than this one. So that is why it's a higher high. Okay. Then you have this one again, higher low, HL. Is a low that is higher than this low. So that's how you will have series of higher highs, higher lows, higher highs in an uptrend. Okay, so now this one is a higher high, and this is a higher low. Don't forget that I skipped some because I wanted to move faster. Now, you now have this, because this, let's assume I move this guy to this place. So you now have this as higher high. All right. It's higher than this one yet, okay? So this one is also higher low. Now, this is the last higher high we got. If you look at it, it's higher than this one. So let me bring my cursor, look at it. Are they equal high? Okay, so more like equal high, okay? So you can also call this one, you can call the two of them high, all right? Okay, so now this was the previous higher low, but something has happened here. There was a break of this low. Okay, now for this to happen, which means the market is about to change direction. You know, previously when the market was going up and down, the movement, all right, the low are always maintained. So the new low is always higher than the previous low. And the new high is always higher than the previous high. But we got here and we saw that the previous low was broken to form another low. So you can see that this low was a higher low. Now this one now become a low. This is a low. Now this here becomes lower high. It's a lower high. Okay? So this is a lower high and this is a lower low. This is a low first and this is a lower high because we already have a high here. This is a lower high. Now, if you further come down, you now see a lower low, LL. Why? Is a low, but it's lower than this one. That is why it's a lower low. Okay? Again, you have a higher, a lower high here. Or we can say here. Okay, no, it's here. Okay. Lower high. Okay? So, but in this case, the market just broke up and down. It wasn't too direct and straight. But what happened here is that the market came down shortly, it moved up again. Okay? So this now was the low. that was the lowest. Okay? Now, this low couldn't take out this low again. This low couldn't take out this low. So you want to say this is now a higher low. And this high has taken out this high. So this one becomes a higher high. Okay? So this is another low. This low did not take out this one, so it becomes a higher low. Then you come straight to this end and so on and so forth. So this is how the chart moves. So when you have a series of higher high, higher lows, is in an uptrend. Then when you now have a series of lower low, lower high, is in a downtrend. Now the English may sound bogus and too heavy right now. There is always like that. Over time, you get a better understanding and it will begin to sink. But seeing it for the first time like this, it may be looking confusing and somehow. But a time will come when you reckon to say, oh, okay, this thing that he was explaining the other day that was looking too difficult, now I got it. It's always like that. Okay, so now we have looked at support and resistance. Now we have also looked at uptrend and downtrend. Okay, now let me go back to that place where I blocked. Okay, where I put a rectangular block. Okay, so we've seen uptrend and downtrend. So now let's come back to what we call consolidation. Now this place now, this is consolidation. This is a range, okay, a ranging market. So now some person would tell you to stay clear. Me, I don't trade the range anyway. All right, I don't trade range. But some person, this is their best market when the market is ranging. So they will take it from bottom to the top. They wait for a signal to show that the market wants to drop again. They take it down. All right, take it up to the upper level again. Wait for a signal, they take it down. That is how some person trade until the range is broken. All right, that the broken out to the upside or the downside. So this is a ranging market. Okay, so this is the range. So we have uptrend, downtrend, and a range. Okay, so I think I've been able to show you what brought us into the chart. So we're going back to the presentation right now. All right. So let's come to lots and pip calculation. Lots and pips calculation. Please pay attention. Now, for you to manage your risk very well, risk management, you must understand what lots and pips are. So this should be one of the first things you want to really understand very well and you want to master very well. All right, like I said, I'm going to drop some short videos of Adeze Duncan in the group of how she calculated lot size, support and resistance, trend, and all of that. I'm going to drop them. It will help you. They are short videos. I think they are about 10, 15 minutes each. That 10, highest 20. All right, they will help you. Okay, so what are lots? What are lots? Lots are volume, the currency unit you make when a trade covers some certain distance. Also having in mind that when it goes against you, it will be in the same measure. We have the following lot size. So now lot is the volume at which you go into the market. Okay? The volume, you use to go into the market. So now let me use gallons, for instance. Okay, so let's have about 4 persons. The first person is holding a 4-liter gallon. The second person is holding a 25 liters gallon. The third person is holding a drum, that drum of 250 liters. One person is using that same drum. Then we also have one guy who is coming with a tanker. These four persons are going to the river to fetch from the same river. Now, the question is, the person who went to the market with the, I thought I would need response, so let me allow you to be able to unmute yourself in this case, because I would want to hear response on this one. Okay, so now look at it. One person went with 4 liters gallon, another with 25 liters, one with a drum. A drum is usually 250 liters. Then the fourth person with a tanker. They are going to the same river to fetch water. Now, are these four persons going to be coming out with the same quantity of water? I need response.
No, sir.
Of course, no. Of course, no. Yeah. The person who went with a tanker will definitely come with more water. Is it not so?
That's true.
That's big. That's huge. Someone who went to the river with a tanker, the person can can supply a community water. Then the person who went with 4 liters gallon, maybe that's just for himself and his family. Okay? So now they have fetched this water. So let's assume, okay, the same water they have. Now, if it happens that they lose this water, these four people were having these sizes of gallon and tanker, and it happens that every one of them lost the quantity, the volume of what is inside. They lost everything. Who will lose more?
The person that went with the tanker.
Yes, the person that went with the tanker will lose more. Who will lose less?
The person with a 4-liter
4
gallon.
liter gallons. Is as simple as ABC. It's the same thing. That is just the best way to show you what lot size can do for you. Okay? So your lot size can either make or mar you depending on your account size. Okay? So now let's now go into explaining exactly what it looks like. But with what I have shown you now, that is exactly what it means. So you are going into the market, you have a $100 account. You don't have to use a big lot size like someone who is coming into the market with $10,000. The person who is coming into the market with $10,000 can decide to use a higher lot size. But you have $100. You should use the lot size that is commensurate with your account. That is exactly what this means. And that is why it is volume. So let me go through the definition again. Say, lots are volume. The currency unit you make when a trade covers a certain distance. Also having in mind that when it goes against you, it will be the same measure. So we have the following lot sizes. Okay? So we have the micro lot, all right, which ranges from 0 to 0.1. I mean 0.0.1 to 0.01 rather to 0.09. Okay? 0. Now I'm not starting from standard, all right? I'm starting from the micro. Micro is 0.01 to 0.09. That is a micro lot. Then we have the mini lot. The mini lot is 0.1 to 0.9. Then we have the standard lot size. The standard lot size is 1. So 1 to, you can count as much as 1,000. All right? If you have $1 billion account, why not? You can use 1,000 as standard lot size. Okay? There are people who trade $1 million account, people use 100, 150 standard lots. All right, so now let's look at the value in pips. We'll get to pips, but let's look at the value in pips. Now, pips is actually the points, the distance cover, all right, is measured in pips. Okay, the distance, the movement is measured in pips. All right, we're coming to pips. So now let's look at the value in pips. Now, one standard lot is equals to $10 per pip. So imagine that you have a $100 account and you are using 1,000 lots. What it means is that it takes only 10 pip movement for the account to disappear. Only 10 pips, the account will disappear. Okay? So one standard lot size is equals to $10 per pip. The mini lot, 0.1, okay, is equals to $1 per pip. 0.09, 0.9 is equals to $9 per pip. So you want to know how to use it. So which means on your $100 account, if you use 0.1, only 10 pip movement, $10 is gone. And that 10 pip movement can be within a minute or two. For gold can do that in less than 10 seconds. Then micro is 10 cents per pip. So 0.01 is 10 cents per pip. So you need to move up to 10 pip to get $1. In the same vein, when it's going against you, you need to go up to 10 pips for it to reduce, to depreciate your account, for account to go down below up to $1. So I believe we have a better understanding of this thing now. So leverage, we talked about leverage yesterday. Was it yesterday or the day before? This is when your broker allows you to use additional funds to be able to trade Forex, a borrowed capital to increase your potential return. E.g., 1:400, 1:1005, and so on. All right, so that's leverage. So let's go to pips. So what are pips? A pip is a unit that expresses the change in the market. I say a pip is the distance a price travels from one point to the other. It is called price interest points. Movements of price action. The pip is calculated as the fourth digit after the decimal point, but an exception of JPY and gold pairs. Now, every currency have 5 decimal places. All right, every currency have decimal places, 5 decimal places, the price. Now, the fifth one is regarded as a pipette. It is not used in calculating your, when you are calculating your pips, it's not used in calculation. So the fourth decimal is actually the first pip. Okay, so the fifth one is a pipette, it's not calculated. So taking 20 pips TP and 30 pips XL. So let's look at this arithmetic now. Okay, let's look at this arithmetic. E.g., okay, now let me explain that. I'm talking about currencies, right? Currency have 5 decimal places, while JPY, that's why you say bet, an exception of JPY and gold pairs. Now, JPY has 2 decimal places. All right, it's actually 3, but the third one is a pipette. So it's in 2 decimal places. Okay, so you disregard the third one the same way you disregard the 5th one in the case of the other currencies. So let's look at this. GBP AUD was given for a price. GBP AUD was given for a buy at 1.38765. Taken 20 pips TP and 30 pips stop loss. So now what this is telling you is that this 1.38765 is the entry point and you are buying. When you are buying, your take profit is above your entry price and your stop loss is below your entry price. When you are selling, your take profit is below your entry price and your stop loss is above your entry price. In this case, we are buying GBP AUD. So now let's look at this. So 1.38765, the last, which is 5, is the last which is ignored is 5 because it's called a pipette, which is a unit of a pip. But 6, which is the fourth after the decimal, is the pip. Then whatever pip will be added is starting from the pip, which means it becomes 1.3876. So now 1.3876 plus 20 pips. So you can see that 20 pips now is calculated at 0.0020. That's 20 pips. Is equals to 1.3896. So your take profit now is 1.396. Then your stop loss is 1.3876 minus 30 pips. And the 30 pips here is 0.0030, which is equals 1.3846. That is the simple calculation of your take profits and stop loss. Now I'm going to give us assignment. I gave assignment yesterday. It's only 2 persons that did it. Well, the assignment is not taking us, we are not using it to give certificate, but it's for your own good. If you practice all of these things, you will get a better understanding, and whatever you understood will remain with you. And this is the most critical of it all. If you don't know how to calculate stop loss and take profit, you have not started. Even though when we give trade these days, we give you trade signal and we just give you the figure, take profit and stop loss. Your own is to go and plot it. When we started this journey, people like us, they don't tell us this is the price. They'll tell you your take profit is 30 pips, stop loss 10 pips. Take profit 70 pips, stop loss 100 pips. So it is left for you to do the calculation. They'll say buy gold now. Stop loss 70 pips, take profit 100 pips. So if you don't know how to do the calculation, how are you going to put your stop loss and your take profit? So you take a trade you already bought and now the trade is going against you. You don't know what to do. Oh, they say stop loss 70 pips. How do I put it now? And you already entered. So this is very critical. Yes, the age we are today, everything has been made so simple. People give you trade and they just give you the figure. Your own is to enter them. But knowing them will help you a lot. All right, knowing how to calculate these things will help you a lot. Okay, so let's go to the next one, which is the exception of JPYs and gold pair. Now, for this pair, the second digit after the decimal is considered as the pip. All right, the second digit after the decimal. Okay, so the second digit, yes. Okay, is considered. So GBP JPY is given at 123.898 for a sell, given 10 pips TP and 20 pips stop loss. 123.898. The 8, which is the last digit, is the pipette, which is ignored. The 9 is the second digit after the decimal, which is the pip. So TP will now be 1, 2, is it me that did this? Okay. So the TP will now be 123.898 minus 0.000.10, okay, which is the 10 pip take profit. And it's for a sell. That is why you see this minus. Sell. If you are selling, your take profit is below. So it's a minus. Your take profit is going to be lower than your entry price. So in this case, we are minusing 10 pips from the price, which is the 123.898. But we have taken the 8 out because it's ignored as a pipette. Okay, so which means your take profit is 123.79. 123.79. So for the XL, we put it 123.9898 plus 0.00.20. So our stop loss will now be 124.098. It's as simple as that. Note, it is a sell market because we want the price to go further down. We subtract from it to get profit. Okay. So for gold is the same thing. So for gold, that is the same way it is calculated. All right. Okay. So this is where we end it for tonight. Okay, trading window. I think I dropped this thing again. So this is where we end it for tonight, and we'll be asking questions now. And I'm also going to give us assignments. All right. I hope that we'll see one or two people who will do the assignment, and I'll give you the videos to watch. The videos will help you. You have enough time to do this assignment because we are supposed to be here tomorrow, but I won't be available tomorrow, and I will be available for the whole of the weekend. I'm having a wedding, traditional wedding tomorrow, and Saturday is the white wedding. So by His grace, I'm leaving town to return on Sunday. So Monday we'll continue with the fourth day, day 4. Then we're going to do Monday to Friday, which will be day 4 to the 8th day, which is the 8 days of the 2 weeks. Okay, so I'm going to stop share here. I'm going to stop recording rather. I'm going to stop recording so that we can begin to ask our questions.